Imagine waking up to an extra $500 in your account every month without lifting a finger. Sounds like a dream, right? Well, it might be closer to reality than you think. High-yield ETFs are shaking up the investment world, and you won't believe what some investors are earning. But here's the question. How do these funds manage to pay out so much? In this video, we're uncovering 3 game-changing ETFs that are redefining income investing. These aren't your typical dividend stocks. They're sophisticated funds using advanced strategies to potentially deliver yields of 7%, 9%, even 10% annually. Ready to discover how these monthly income machines could transform your financial future? Let's dive in and see what makes these ETFs tick. Imagine waking up on the first day of every month to find a fresh deposit in your bank account. Sounds pretty nice, doesn't it? For many of us, this scenario feels like a distant dream. We're all too familiar with the stress of living paycheck to paycheck, constantly juggling bills and hoping there's enough left over for savings or enjoyment. Traditional investments often fall short when it comes to consistent cash flow. Quarterly or annual dividend payments don't align with our monthly expenses, creating practical and emotional challenges. Picture this. You've just paid your rent and utilities, leaving your account nearly empty. An unexpected car repair pops up, but your next dividend payment is weeks away. The anxiety of stretching your last payment until the next one arrives can be exhausting, making it hard to focus on long-term financial goals. But what if there was a way to smooth out those financial peaks and valleys? What if you could tap into the power of the stock market while still enjoying a steady stream of income? This is where monthly income ETFs enter the picture, and they're changing the game for investors like you and me. These aren't your grandpa's dividend stocks or your uncle's boring bonds. Monthly income ETFs are sophisticated financial tools designed to deliver consistent cash flow, typically offering yields that make traditional investments look like pocket change. One such ETF that's been making waves is the J.P. Morgan Equity Premium Income ETF, JEPI. But we'll dive deeper into that later. So how do these ETFs work their magic? At their core, they're investment funds that hold a diverse portfolio of assets. But here's the kicker. Instead of passively collecting dividends, these funds actively manage their holdings to generate income. They might use strategies like covered call options, high-yield bonds, or even real estate investments to keep the cash flowing. The beauty of these ETFs is that they take complex market strategies and package them into a single, easy-to-buy investment. You don't need to be a Wall Street whiz to benefit from these sophisticated techniques. The fund managers do all the heavy lifting, while you sit back and potentially collect the rewards every single month. Let's put this into perspective. Imagine you invest in a monthly income ETF with a 7% annual yield. That means for every $10,000 you invest, you could potentially receive around $58 each month. Now, $58 might not sound like much, but it's a start. And as you build your investment over time, that monthly payout grows too. Before you know it, you could be looking at hundreds or even thousands of dollars flowing into your account each month. This consistent income can be a game changer for your financial life. It can help cover bills, boost your savings, or even fund those little luxuries you've been denying yourself. More importantly, it can provide a sense of financial security that many of us crave. Knowing that you have a reliable source of income, separate from your day job, can be incredibly empowering. Remember the JEPI ETF we mentioned earlier? Since its launch in 2020, it's become a leader in this space. With $38.5 billion in assets under management and a current yield of 7.1%, it's clear that investors are catching on to the power of monthly income ETFs. This fund's rapid growth is a testament to the increasing demand for reliable income streams in today's low-yield environment. It's important to remember that, like any investment, monthly income ETFs come with their own set of risks. The high yields can be enticing, but they're not guaranteed. Market fluctuations, interest rate changes, and other factors can impact the fund's performance. That's why it's crucial to do your homework and understand exactly what you're investing in. But for many investors, the potential benefits outweigh the risks. The prospect of turning your investments into a personal monthly paycheck machine is appealing. It's about more than just the money. It's about the freedom and peace of mind that come with knowing you have a diversified income stream working for you around the clock. Now that we've explored monthly income ETFs, let's dive deeper into what makes JEPI stand out. JEPI holds just 129 positions, carefully selecting from the S&P 500 instead of tracking the entire index. This approach combines carefully chosen holdings with a clever option strategy to generate income and potential wealth. The J.P. Morgan Equity Premium Income ETF, or JEPI, has quickly become a favorite among income-seeking investors. It aims to deliver monthly income while still tapping into the growth potential of the S&P 500. But how does it work? Instead of investing in the entire S&P 500 index like traditional ETFs, JEPI's managers select a portion of large-cap and mega-cap companies. These industry leaders, such as Amazon, Meta, and NVIDIA, form the foundation of the fund. This focused approach aims to capture growth opportunities while maintaining stability. The key difference lies in JEPI's option strategy. The fund sells out-of-money call options on the S&P 500 index, generating additional income. This strategy allows JEPI to potentially produce cash flow in various market conditions. During calm periods, the option's income provides a steady stream. In volatile times, this approach can help cushion against market downturns, potentially offering more stable returns compared to simply holding stocks. Let's consider a real-world example. Imagine you're a retiree with a $500,000 investment in JEPI. With its current yield of around 7%, you could receive about $2,917 in monthly income. This consistent cash flow could cover essential expenses like rent, utilities, or healthcare costs, providing financial stability without depleting your principal investment. Of course, JEPI isn't without risks. The fund's yield can fluctuate based on market conditions, ranging from 5% to 12% since its 2020 launch. The option strategy, while potentially reducing volatility, can also limit upside potential in strongly bullish markets. And as with any actively managed fund, there's always the risk that the manager's stock selections might underperform the broader market. JEPI's approach offers a unique blend of income and growth potential that's hard to find elsewhere. Most high-yield investments come with significant risk or limited growth prospects. JEPI, however, allows you to potentially benefit from both income and exposure to robust companies in the market. This balanced approach has clearly resonated with investors. Since its launch in 2020, JEPI has grown to manage $38.5 billion in assets. That's a testament to the increasing demand for reliable income streams in today's low-yield environment. More investors are discovering they don't have to choose between income and growth. They can potentially have both. So, is JEPI the perfect solution for every investor seeking monthly income? Not necessarily, but it does offer a compelling alternative to traditional dividend-focused ETFs. By combining monthly income potential with exposure to high-quality S&P 500 companies, JEPI provides a unique tool for investors looking to balance income and growth in their portfolios. Imagine combining the growth potential of tech stocks with impressive monthly income. Sounds unlikely, right? But that's exactly what JEPQ, the J.P. Morgan Nasdaq Equity Premium Income ETF, aims to do. This ETF challenges the idea that tech stocks are only about growth, not income. JEPQ focuses on the tech-heavy Nasdaq 100 index, homes to giants like Apple, Microsoft, and Amazon. These companies are known for innovation and rapid growth, but not typically for high dividends. So how does JEPQ manage to generate high income from this sector? The answer lies in JEPQ's clever strategy. It's like running a tech lemonade stand with a twist. JEPQ holds a portfolio of Nasdaq 100 stocks, giving you exposure to some of the most innovative companies. To boost income, it sells call options on the Nasdaq 100 index. This is like promising to sell your tech lemonade at a set price in the future. If tech stocks soar above that price, JEPQ might miss some gains. but in return, it receives a premium for making that promise, which it passes on to investors as income. This approach allows JEPQ to potentially generate income in various market conditions. When tech stocks are stable, the options income provides a steady cash flow. During volatile periods, the strategy can really shine as options premiums tend to increase, potentially providing even more income. The results have been impressive. JEPQ's yield has reached as high as 12% in early 2023 and currently offers a 9.4% yield paid monthly. That's substantial, especially from a sector not known for high yields. But here's where it gets interesting. With JEPQ, you're not just collecting income. You're maintaining exposure to dynamic companies like Apple, Microsoft, and Amazon. Imagine earning monthly income while still benefiting from the long-term growth prospects of these tech giants. Of course, there are trade-offs. The option strategy can limit upside potential in strongly bullish markets. If tech stocks experience a prolonged rally, JEPQ might not capture all of those gains due to the call options it has sold. Additionally, the tech sector can be notoriously volatile. While JEPQ's approach may smooth out some volatility, it's not immune to sector-wide downturns. A prolonged slump in tech stocks could potentially impact both the fund's income generation and its overall performance. So is JEPQ right for every investor seeking tech exposure and monthly income? Not necessarily, but it offers a unique balance of income and growth potential. If you're looking for pure tech growth, a traditional NASDAQ 100 index fund might be better. But if you want a mix of income and growth with a tech focus, JEPQ could be worth considering. As we transition to our next topic, it's important to note how JEPQ differs from JEPQ, which we'll explore next. While both aim to provide income, their approaches and focus areas are quite different. JEPQ concentrates on tech stocks, while JEPQ takes a broader approach. Understanding these distinctions will help you make more informed decisions about which ETF might be right for your portfolio. We've seen how JEPQ can blend tech stocks with income, but what if we could push this strategy even further? Enter JEPQ, the Goldman Sachs NASDAQ 100 Premium Income ETF. This fund takes the concept of generating income from tech stocks to a whole new level, and it might change the way you think about high-yield investments. JEPQ improves on JEPQ's yield through a crucial difference in their option strategies. While JEPQ sells out-of-the-money call options, JEPQ sells at-the-money call options. Imagine you're selling insurance on your car. JEPQ's approach is like selling insurance that only kicks in if your car's value increases by 10%. JEPQ, on the other hand, sells insurance that activates as soon as your car's value changes at all. This means JEPQ can collect higher premiums, translating to more income for investors. Currently, JEPQ offers an impressive 10.19% yield paid out monthly. Let's break this down with a practical example. If the NASDAQ 100 index is trading at $15,000, JEPQ might sell call options with a strike price of $15,500, while JEPQ would sell options at $15,000. JEPQ's options are more likely to be exercised, commanding a higher premium. However, this strategy caps potential gains at the current market level. This scenario highlights the pros and cons of JEPQ's strategy for different investors. For retirees or those prioritizing a regular cash flow, JEPQ's higher yield and potential for better performance in flat or slightly bearish markets can be appealing. The monthly income stream provides stability and predictability. However, investors in the wealth accumulation phase might find JEPQ's capped upside limiting. In strongly bullish markets, JEPQ could underperform both JEPQ and the broader NASDAQ 100 index. These investors might prefer JEPQ's balance of income and growth potential over even a traditional index fund for maximum growth. It's important to note that JEPQ isn't solely about income. The fund maintains exposure to 112 innovative companies, including tech giants like NVIDIA, Apple, and Microsoft. So while you're collecting monthly income, you're still invested in companies shaping our future. The key is understanding how JEPQ fits into your overall investment strategy. It's a specialized tool designed for a specific purpose, maximizing current income from tech investments at the cost of some upside potential. For those seeking high yield and willing to trade off potential capital appreciation, JEPQ could be an excellent choice. However, a balanced approach might involve using JEPQ as part of a broader portfolio strategy. You could combine it with more growth-oriented investments to create a mix that aligns with your financial goals and risk tolerance. Remember, the right investment strategy depends on your individual circumstances, time horizon, and market outlook. Picture this. You wake up on the first day of every month to find a fresh deposit in your account, not from your job, but from your investments. This isn't just a dream. It's a reality that a well-constructed portfolio of high-yield ETFs could potentially create for you. Let's explore how you can combine JEPI, JEPQ, and JEPQ to build a portfolio that pays you monthly and potentially transforms your financial life. The key to success isn't just chasing the highest yield. It's about finding the right balance between income, growth potential, and risk management. Each of these ETFs has its own strengths. JEPI offers broad S&P 500 exposure with a solid yield. JEPQ focuses on tech stocks while providing impressive income, and JEPQ uses an aggressive option strategy for high yield. So how do you decide which ones to include and in what proportions? It all depends on your financial goals and risk tolerance. Let's consider a specific example. A balanced portfolio allocating 40% to JEPI, 30% to JEPQ, and 30% to JEPQ. Based on recent yields, this portfolio could potentially generate an annual income of around 9 to 10% paid out monthly. Remember, these yields aren't guaranteed and can fluctuate based on market conditions. That's why diversification across different income-generating strategies is crucial. By combining ETFs that use different approaches, you can potentially create a more resilient income stream. Regular rebalancing and monitoring are essential to maintain your desired allocation and manage risk. Set a schedule to review your portfolio quarterly or semi-annually. If one ETF has grown significantly larger than its target allocation, consider selling some shares and reinvesting in the underweight ETFs. These high-yield ETFs can serve as powerful cash management tools. Instead of keeping a large portion of your portfolio in low-yield savings accounts, you could put that money to work in these ETFs, potentially earning significantly more income while still maintaining relatively easy access to your funds. The potential impact of a well-designed monthly income ETF portfolio is significant. Earning 9 to 10% in annual income paid out monthly while maintaining exposure to innovative companies could help cover living expenses, boost savings, or fund your dreams, all while your principal investment continues to work for you. But here's what makes this strategy truly exciting. You're not just generating income. You're also potentially positioning yourself for long-term growth. These ETFs offer exposure to market-leading companies, so your investment has the potential to appreciate over time. It's a combination of immediate cash flow and long-term wealth building. Of course, it's important to understand the risks involved. These ETFs use complex option strategies that may not perform well in all market conditions. Their yields can fluctuate, and there's always the potential for loss of principal. That's why it's crucial to do your own research and consider consulting with a financial advisor before making any investment decisions. In conclusion, a carefully constructed portfolio of high-yield ETFs like JEPI, JEPQ, and JEPQ could potentially provide you with a steady stream of monthly income while still offering growth potential. By understanding each ETF's strategy, balancing your allocations, and regularly monitoring your portfolio, you can work towards creating a powerful income-generating machine that supports your financial goals. We've painted a rosy picture of high-yield ETFs, but let's address the elephant in the room. What's the catch? These monthly income machines sound almost too good to be true, and as savvy investors, we know that's often a red flag. So let's pull back the curtain and examine the fine print that comes with these enticing investments. First, it's crucial to understand that these ETFs use complex strategies with their own risks and limitations. The options techniques generating those impressive yields aren't magic. They're calculated bets on market movements, and like any bet, things might not go as planned. One key concept is return of capital. Imagine you have a fruit tree that produces 10 apples a year, but you promise to give your neighbor 15 apples annually. To keep your promise, you'd have to give them some of the tree itself. That's return of capital. When part of your distribution comes from the fund's capital, not earnings. It's like getting excited about a big harvest, only to realize you're slowly giving away pieces of your tree. Now let's talk about how options pricing affects ETF yields in different market conditions. When markets are calm, options tend to be cheaper, making it easier for ETFs to generate high yields. But in volatile times, options become more expensive, potentially squeezing yields. It's a delicate balance that fund managers must navigate. Consider taxes too. Let's say you're in the 24% tax bracket and receive $10,000 in distributions from a high-yield ETF. If those distributions are taxed as ordinary income, you'd owe $2,400 in taxes. But if they were qualified dividends, you might only owe $1,500. That's a $900 difference. For someone in the 37% bracket, the gap would be even wider. These ETFs might underperform in strongly bullish markets too. Their option strategies can cap upside potential. If the market takes off like a rocket, these ETFs might feel like they're driving with the parking brake on. Given these considerations, are these ETFs right for everyone? The short answer is no. They can be powerful income tools, but they require careful consideration. Your risk tolerance, goals, and financial situation all play a role in determining if they fit your portfolio. Understanding option strategies is crucial before investing. Without this knowledge, you might misinterpret the risks and rewards. It's like trying to fly a plane without knowing how to read the instruments. You might take off, but you're in for a bumpy ride. The bottom line? High-yield ETFs can boost your monthly income, but they're not a magic solution. They come with challenges and complexities that require careful navigation. Approach these investments with your eyes wide open, aware of both their potential benefits and limitations. Remember, in investing, there's rarely a free lunch. Those juicy yields come at a cost, whether it's increased risk, potential tax headaches, or limited upside in certain market conditions. But for investors who understand these trade-offs and are comfortable with the risks, high-yield ETFs can be a valuable addition to a well-diversified portfolio. As we wrap up our exploration of high-yield ETFs, let's recap the key takeaways. These monthly income machines offer potential solutions to income challenges, but require careful handling. Consider how they might fit into your financial journey, but always do your due diligence and consult a financial advisor. The world of finance is constantly evolving, so stay curious and informed. We'd love to hear your thoughts or experiences with high-yield ETFs in the comments below. In our next video, we'll dive into dividend ETF portfolios. Ever wonder how a well-crafted dividend strategy could lead to financial freedom? Tune in and find out. Until then, keep dreaming big and investing wisely.